Hello and welcome to the HFA Podcast, where we dive deep into the strategies and people shaping the alternative investment industry. Today's podcast, Navigating Credit with Clarity, inside Coherence Credit Strategies, we're exploring the world of liquid alternative credit with a manager who has not only weathered multiple economic cycles, but outperformed through them. My guest today is Sal Naro, Chief Investment Officer of Coherence Credit Strategies, which is an award-winning liquid long-short credit fund recognized for its innovation, resilience, and results. Sal, welcome to the show.
Thanks so much, Mitch, and thanks to Asset TV and the HFA folks for having me on the show.
It's our pleasure. So let's start with the basics, Sal. So Coherence Credit Strategies, you have a reputation. You've been in the industry a very long time. You've delivered top quartile performance for more than a decade. Can you talk about what's different about your approach versus other credit managers?
Sure. So 42 years. Started in Dreyfus in 1982. And I've been in all facets of the credit markets all these years. This fund, our flagship fund, is over 13 years old, and it is a long-short credit fund. We focus predominantly on European and U.S. Credits and sovereigns. And we manage it a very dynamic function and fashion, I should say. So we are actually taking a very equity-centric approach to managing fixed income. So what do I mean by that? I believe that the equity markets are the most foreshadowing markets. Their perception becomes reality, and you see often the direction of the market in the equities and equity volatility sort of before you see that in the fixed income market. So we combine equity metrics and fixed income metrics with ratings trajectories in a really advanced model, quantitative model, utilizing machine learning and now AI, that's very, very predictive around the movement of credit spreads. So we're not looking to invest to get a coupon or to get yield or to get carry. We're actually looking in alongside the portfolio to find names that are meeting and beating earnings expectations, that are on flat to positive ratings trajectories where the credit spreads are actually going to tighten. The other side of that, on the short side, and we make alpha on the short side, we try to find sectors and then names that are missing and lowering earnings and that are on flat to negative ratings trajectories. And we try to position ourselves in front of those shorts and longs, and that's how we create alpha. So we don't create alpha owning the weakest name in the sector with the best coupon and hoping they pay off. Right. We're looking for positive momentum on the longs, negative momentum on the shorts, and bringing that all together in a long-short fashion creates the alpha in the portfolio.
Sounds fascinating. So you're not just chasing yield. You're taking advantage of dislocations when credits deteriorate. That's pretty unique compared to your peers. So tell me a little bit more about that.
Sure. So our approach, everything that we do starts with a global macro view. Basically, a rising tide will lift all ships. So we need to understand what's driving the overall market. For most of the time in the last 20 or 30 years, it's the central banks. So the central banks, start driving the overall markets, and then from there, it goes down to geopolitics, goes all the way down to earnings. But earnings are very important. So we start with a macro view, and then we go with a fundamental view from the bottom up. Then we cross-reference across the board there with our modeling techniques. And really what they're meant to do is forecast. So we're looking at earnings forecasts, ratings forecasts, and we're trying to anticipate how credits are going to behave. Are they going to be delevering? Are they going to be getting upgraded? Their earnings are going to be beating estimates? Or are they in an industry that's challenged, or are they over leveraged? Are they challenged? And are they going to get downgraded? So we try to create this profile throughout throughout the credit markets, looking at shifts up and down, positive and negative, and then we ultimately try to be positioned in front of all that. The interesting thing about all that is that then we add technical analysis to it. And in fixed income, unlike equities, there are hundreds and thousands of bonds, and there's all various maturities. So we try to be a student of the market and understand which maturities in a company's capital structure are going to perform better, maybe rolling into a liquid 5-year or 10-year, and which ones are going to struggle, which type of maturities will struggle, et cetera. So when you look at everything that we do, we're really combining a top-down approach then a bottom-up view of the actual individual companies, applying our models to that to see trajectories, and then looking at the actual bonds themselves and seeing where in the curve, in the credit curve, they should perform the most. And I think the biggest thing that we do, quite frankly, is that when it doesn't work for us, we're getting out, we're getting smaller. So unlike many advisors or managers, we don't average down, we don't double down, we don't get bigger in any losing investment, whether it's a long or a short. Our view is most of the time, the ones that are performing well continue to perform well. The ones that are performing lousy, there's a reason for them, and they continue to perform weak. We try to get in front of it and then ride that trend. When it's not working, when we're wrong, and we are wrong, after 13 years, we've been wrong many, many times. Right. But the difference is that when we are wrong, we cut our losses very, very quickly. We let our gains run. And over any elongated period of time, if you do that, cut your losses quickly, let your gains run, you will outperform the market. And that's what we've done in this strategy for 13 years.
It's fascinating. And so you indicated or have described Coherence as a liquid complement to private credit, public and private equity, and structured credit. So for institutional investors that are listening to this interview, how do you see your strategy fitting into those broader portfolios?
Most of our clients position us as a long-only fixed income substitute in their portfolio. So where they might have just long-only fixed income or long-only high yield or even long-only investment grade, they typically would position us. We don't take much in the way of interest rate risk. So we hedge out our rate risk, we hedge out our currency risk, and we try to just to identify just the credit exposures, and we try to create alpha with those credit exposures. So to give you an example, we run on average a BBB minus or a lower investment grade average rated portfolio, and we have materially outperformed the high yield indices for 13 years. So we outperform high yield with investment grade quality. And we do that by, again, using that analysis that we talked about. Sure. And very importantly, when we're wrong, get out. But when we're right, we stay at the table. We get as big as we can based upon our risk limits, and then we hold. We have positions, honestly, in sectors and names for years. We also may have them for an hour or 2 hours if we made a mistake on something. A piece of news comes out and we didn't realize it. I'm not going to say, oh, maybe it'll come around. We made a mistake. The market tells us whether we're right or we're wrong. We move on. And because we're liquid, unlike private credit, et cetera, and so on, we can make those changes. We can manage dynamically in the portfolio. So our portfolio is for people who want transparency, want low fees, and want liquidity. They need money. You're out in 30 days, 30 days notice, 15 days notice. It's a very liquid strategy, and people know that they can get their money when they need it.
So in this overarching strategy through Coherence, you've integrated AI in some capacity. Can you describe that a little more?
Sure. So we run this multi-factor model, and we've been running it now for many, many years. It's housed at S&P Global. And so the formula is ours, but the model is housed there. And it takes thousands of names, if you will, and cross-references them with the ratings trajectories and the ratings agencies and many other factors, social media factors, all sorts of factors that figure in, and we back-tested it. And we continue to refine it every 6 months, but it's pretty solid. What it does then is create this scale from 1 to 100, and it ranks all these various companies from 1 being the best, 100 being the worst. You kind of know what the best credits are and kind of what the worst are. The interesting thing is we're looking to see which credits are migrating up, getting better, down, getting worse. And we try to understand the speed that they're improving or declining. So it may have to do with leverage, it may have to do with earnings, it may have to do with the entire industry. It may have to do with politics and elections, sure. Things that are going to change the outlook for companies. Like right now, that's a challenge because the outlook politically and regulatory keeps changing. So it's more difficult to sort of see the forest through the trees in this environment as it sits today. But we try to anticipate those moves and position ourselves in front. And now what we're doing with AI is we're able to take the results of the model. The model spits out to us buy and sell recommendations twice a day. You could also go in and ask it questions and pull stuff out. And that's all machine learning driven. Now what we can do with AI is, and I use Grok, that's the one I prefer to use, but there are quite a few good ones. Sure. We pump our results through there, and then we verbally ask it even further questions. What other companies are like this? What did the company do 2 years ago, 6 months ago? What do you think it's going to do? Just like you and I having a conversation, I'm literally having a conversation with the AI, and we're going back and forth. So what would have taken me hours or days maybe to break apart a balance sheet or to go through various questions I have, we're literally doing it on the fly. And this is just for us, just happening over the sort of the last 6 months. And I think, clearly this is just the beginning. Right. So what does it do? Ultimately, it allows us to view more credits with the same number of people. I don't need to have less people, but it's making my team, which is small to begin with, modest, it's making us even more scalable. We're able to look at a larger range, a wider range of data, sure, almost instantaneously. Right. It's absolutely fantastic. And it has led to some deliberate wins this year that we may not have had, in the old process, which would have taken a little bit longer. And we're just really starting to get our arms around it.
It's fascinating, and I want to dive a little bit more into that, because the idea of, I've been in the industry a long time as well, not as long as you, but I will tell you the factors that an investment manager brings to the table to determine what they're going to do. Now what you're describing with AI is on steroids. I mean, the ability to integrate stuff, including social media, that was not a possibility 10 years ago. And now, you can do it in a conversation with artificial intelligence. It's amazing.
Perception really does become reality, at least in the short term. Mm-hmm. And so in the fixed income world, we don't have meme stocks and things like that. So Thank goodness we're not dealing with that type of approach. But perception really does matter tremendously, and people's anticipation of what's going to happen, why it should happen, and whether the regulators are going to allow it to happen. All these things are very important to creating alpha. And now with the AI models, you can even say, as we're looking at a credit that we think has M&A potential, you can instantaneously say, well, what other companies like this? What did the regulators say about that? What year was that? What did they actually say about it? Was this company ever looked at before by somebody else? And really, if you use these tools properly, you can almost get the information instantaneously. So I'm not worried about AI replacing managers like myself. I think that there's a place for active management. Sure. I also think there's a place for passive management, and I get it, but I think there's a place for active management. And at the end of the day, where active managers really are supposed to come through is when the markets really disrupt. And even more than that, when they disrupt on the downside. And you're supposed to be able to protect your investors' capital. We have a ton of our own money invested in our fund. So we have our money right next to our investors, right? We bleed. The customer bleeds, we bleed. We put our investors first. And you're supposed to be able to really outperform when the markets have this tough time. And I think if you go back and you look at our performance and you look at our Sortino and Sharpe ratio, you'll see that we really, really protect on the downside. Now, people may say, well, we'd like to see you make a lot more money on the upside too. And we do, and we've had some tremendous years on the upside. But at the end of the day, you're not investing in fixed income to hit home runs. You're looking for a consistent return profile that's going to protect your portfolio, give you some consistent total return. I don't want to say consistent income, because I don't believe in income. Because if you're getting if a bond's paying you income, but the principal's going down constantly, your total return is negative, but you're getting cash, you're effectively paying yourself. That's not a winning strategy. So you have to look at total return. And what we do is we bring balance to portfolios. We bring balance to equity positioning. We bring liquidity to private credit, to public, to private equity, right? And at the end of the day, you have to say to yourself, when you make a balanced portfolio, if we're annualizing, I'll throw a number out there, at the risk-free rate of return plus 600, and private credit says they're giving you risk-free rate of return plus 800. What is the value of having transparency and having liquidity versus having no transparency and very, very liquidity. What should that premium be? Doesn't mean you shouldn't have those private investments. You absolutely should. But you shouldn't have just that. You should have a myriad to be diversified. And that's what we provide. So people put us in their portfolio, long-only fixed income substitute. Everybody loves private credit now. Who knows how much leverage it has? It has no transparency and no liquidity, but it promises high returns, and investors are flocking to it. Can't just all have just that. And even we're even positioned in some people's portfolio as a money market substitute, like a enhanced money market, an 18-month type of investment. Because if you look at our drawdowns throughout the 13 years, they've been very, very de minimis, right. And our recovery is really quickly. So when you look at it from that perspective, we are a pretty conservative return profile. Past performance is no future indicator. I completely understand that. But I will say that past performance over a long period of time with a consistent process is a pretty decent future indicator of what an investor can expect. And we have zero style drift. I've sat on the boards of many companies. I sat on the board of Long Island University, where I was a trustee for 15 years. I advised some other colleges in their endowments. The one thing I can't tolerate as an investor is style drift. Sure. You tell me this, you sell me that, this is what I expect from you, and all of a sudden it changes. Even if it changes dramatically to the positive, I've got a problem with that.
Right.
I didn't hire Sal Naro to be my Bitcoin manager.
Right.
Right. I hired Sal Naro and his fantastic team to be a consistent return profile for fixed income credit as a diversifier in my portfolio, and I'm not expecting them to be invested in, loans or structured credit or distressed or crypto. I have other guys for that. That's not what I'm doing for you. So zero style drift.
Right. And I think that consistency has led, in addition to the performance and your team, which most of which I know, to a lot of awards. So can you talk a little bit about all of the awards that Coherence has not paid for, but has won over all of these years?
Yeah, I mean, we've won, I think, 5 or so. I don't get all wrapped up in awards from that perspective. I mean, it's better to have them than not have them. And the ones that you like are the ones that are recognized by the industry. And I think even beyond that, we have a lot of street cred. We've been around a long time. I have a great team. We've worked together for, a long time. I mean, the average experience of my team is 25 years. Most of these guys have worked with me, going back to Bear Stearns and UBS days. So we're going way back. And we've been through every different type of market together, really sort of since the '87 stock market crash. And I've been with you, for many years, since the early 2000s. Yeah. So I think that the award that I like the most is the award of investors' confidence and trust. That's what it's all about. It's a privilege to manage other people's money. Right. I guess my problem is that I take it personal. I mean, to me, it's really personal. And so when we don't perform as well as I'd like, I hate losing money more than I like making money. Yeah. It's just a very personal approach to money management.
It is, but I have to tell you, and I have known you for a lot of years. It's to be respected to the fact that your team has stayed with you for as long as they've had, for decades, and I think that matters. I think from an allocator standpoint, everything you said about style drift and these other things, as an investor, you're looking to slice up that pie of money that you've got to allocate, and you're looking for people to fill in certain specific components. And when a fund manager does X when they say they're doing Y, it throws off the rest of the plan. And so sticking to your strategy, having a core team that understands you and all of you know how each other ticks, I think that matters. And I think from an investor standpoint, people have to respect you with your opinion that if you lose, it hurts. Because you're invested too. And I think that being invested alongside the people that you're seeking to invest with you, I think that carries a lot of weight, and it's very important, and I commend you for it. And I wanted to talk a little bit more about your 4 decades in the industry. And I made this joke earlier before we were on camera, but I think back when you started, we both had hair. You've kept it. So tell me a little bit about that career trajectory that you've had, because you've been on the buy side, you've been on the sell side. Tell me a little bit about where you've worked and what you've achieved.
Yeah, I mean, I'll try to make this quick as I can. But really, starting in 1982, right out of college, I went to Long Island University. I'm involved with the school at many levels, including, as I said to you, on the board for many, many years. I played football there. I was a scholarship athlete. I got hurt my senior year. Halfway through, I realized, like every American kid, you think, if you're any good, maybe you can play in the pros. And I was pretty good, but I was probably never going to play in the pros. But I got hurt pretty bad my senior year. Anyway, I realized at that point in time that my career in football was over. So I had to do something else. And I needed to try to find something that would give me the rush, the energy, the competitiveness, the teamwork that playing football did. So I played in high school, Half Hollow Hills. I was all league, all county. I was a 3-year starter at CW Post. I'm in the Post Hall of Fame. I mean, football was a huge part of my life, right? And as a smaller guy, I always have a chip on my shoulder. I worked out more, had to run more, had to do all these things to be competitive, but I loved to compete. And I stumbled into the world of Wall Street. And in that world, quite frankly, particularly in those days, was kind of like a locker room. Sure. I mean, it was crazy on the trading desk, it was crazy on the New York Stock Exchange. And I kind of took to that world like a duck takes to water. It's competitive, it's teamwork. You pick a couple people who mentor you. And it was just, the 80s were super exciting. Tremendous amount of deregulation took place, the fall of Glass-Steagall. The industry was booming. And I just got very fortunate and hit it at the right time. Started out, like I said, at Dreyfus in the mutual fund area, and just sort of worked my way up from various types of companies, because I didn't have a Harvard, I didn't have an Ivy League degree, I didn't have family connections. So I sort of worked my way up until I got to Kidder Peabody, and right before and after the GE takeover. So I think I put a piece out on this on LinkedIn a year or two ago. I think it was something like 63 companies that no longer exist in my time on Wall Street. Kidder, A.G. Becker, I can just go on and on and on and on. So there's been tremendous transformation as the capital markets got bigger, and I was fortunate enough to situate myself in that world of fixed income and in bond trading, had great mentors, and just kind of worked my way up as the markets progressed. So it's been an incredible run. I look around now and people wear, not many people wear suits. Men wear rubber-based shoes or sneakers. My world was dress jacket and tie.
I love the ties. So
hard-bottom shoes,
yeah.
And no wonder why we couldn't walk after a couple of days, walking on the hard-bottom shoes. Everything has changed. That's right. Bit of work from home and everything. So there's been a tremendous change over these past 40 years. I started out on the dealer side as a dealer, Bear Stearns, UBS, Kidder Peabody, as I mentioned. And I went to the hedge fund side in the very early days of multi-strats, and I was co-managing partner in a hedge fund called Sailfish, which you helped us with. Mm-hmm. We unwound that in 2008, that fund, and I moved to the vendor side. So I've been on the sell side, sure, the buy side, and the vendor side, all three sides of the business. Had a terrific time working on the vendor side with Lance Ugla, who was the CEO of Market Group, CEO and founder, who brought that company from zero to, hero, if you will. Yeah. So I really got to see some tremendous changes in the industry, and I've been able to ride that along. And, I'm asked all the time, why don't you retire? You must have made enough money. It's never been about money for me. It's about competitiveness, doing the right thing for our investors, and taking care of my team, my family, and my clients. And I just love to compete. I don't know what I would do if I wasn't managing money. I'm not a big golfer. I don't do a lot of other things. So, my day starts at like 3 a.m, legit, and it goes till 7 or 8 o'clock at night. And I work on Saturday mornings, and it's a lot of research. It's a lot of podcasts now. Mm-hmm. Tremendous amount of podcasts. So listen to some phenomenal people who bring on great guests. I walk a tremendous amount, so in the mornings, very early, 6 a.m. or so, I'm walking, I'm researching, I'm listening to podcasts, I'm talking to various team members in the U.S. and in London, talking to analysts, talking to salespeople. And so really, a large part of my life really revolves around the business. Yeah. And then it all revolves around performance, because this is a performance-based business. And if you don't perform, you got a problem. So we just work hard on being consistent and trying to perform at the best of our abilities all the time. Not always easy. We've had some bad, some tougher times, but we always recover very quickly because we cut those losses quick. Sometimes you just make a mistake. Sometimes somebody knows something you don't know.
Sure, but I think it's the longevity and the knowledge that you've earned through all of those different parts of and facets of your career, because the idea of being on all sides of this equation, from the vendor side, from the buy side to the sell side, as you say, that gives you a view that normal portfolio managers don't necessarily have. They don't have access to understanding what's happening on the other side of the equation, what's happening over here. Being able to amass all of that, I think, gives you great value. And also, having known your team at Coherence, and the fact that they stick with you all of that time, that too is a testament of people that believe in you because you believe in them. So I think that matters a lot. So I appreciate it. So it's not all work in Wall Street. And I know you're walking and studying things throughout your day to formulate the ideas that make your company and portfolio possible. What do you like to do when you're not working? What are some of the things that you like to focus on?
Well, I'm not going to lie. I mean, it is almost all work for me. I mean, I'm obsessed.
You're not alone.
I'm obsessed with it. It's 18 hours a day, and I love it. It energizes me. Things that I do around that, obviously I spend time with my family. I'm married for almost 40 years. I have 3 children. I have 5 grandchildren. I'm involved in quite a few charities. I'm involved with various hospitals, both in New York and in Florida, where I'm a full-time resident. I'm involved with various preservation societies and things like that. I'm involved with some drug addiction charities. I mean, all these things are super important, and I feel that I'm incredibly lucky and blessed, so I try to give back across the board. I'm involved with mentoring and tutoring some young students, if you will. So, from that perspective, and that also, inclusive in the business, I'm teaching investing, I'm teaching life lessons about investing. Investing is a lot like life. You get kicked in the teeth a lot. You got to make sure you know how to get up and be resilient. So, investing in life are very, very similar. On the other side of that, I enjoy a lot of music. So I have a very diversified musical taste. I enjoy the ocean. I spend a lot of time on the water as I'm working. I have Starlink on my boat that I spend a lot of time on, for instance, from time to time. And I'm always working, but I love to be on the water. I love to be on the ocean. So, sort of music and nature, and really then focused around the business. The business kind of gives you everything. It gives you a lot. It gives you a lot of competitiveness. It gives you the ability to help people. And if I wasn't making money and successful, I wouldn't be able to give as much money to the various causes that I like to support. And you also give time, but money's really important too.
But I think it's something that I think I'd like more people like you in our industry to really take advantage of. Your career was made possible by the people that mentored you, by the people around you that chose to lift you up and gave you opportunities that you wouldn't have otherwise had. And I think there's something to be said for people like you that turn that around and do the same thing for future generations.
Look at Ace Greenberg, Bear Stearns.
Yeah.
You became a senior MD. You had to give a specific amount of money that you made to charity. He mandated it. I mean, who was a better mentor than that?
Yes.
That type of person.
Yes. Well, I'll tell you, not to make this about me, but I have tried to do some charitable things. It all started with my mom growing up. We were feeding the homeless, and she was painting with drug addicts, trying to get people to do things that were better and would open opportunities for them beyond that silo that they were in. And I think it's important. And I think we see a lot of people in Wall Street and finance and our industry who amass all this money, and not you, but I've told other PMs, I said, don't leave it all to your ungrateful children. Do something nice. And there's lots of great charities and opportunities to do nice things and good, and do good in the world with good people like you. So thank you very much.
There's not enough people, Mitch, that talk about. There's not enough people that talk about the fact that many people who've been successful give back. They give to charity. Europe is a fantastic place. Asia is a fantastic place. I don't see or hear or read about a mandate or sort of a proclamation through those other countries. I don't see any other country where individual people give to charity like they do here in the U.S.
Right.
At all.
Right.
And I'd love to see that, that sort of adage grow, but I don't see it anywhere else. So I think I don't want to say it's a uniquely American thing, but it's one of the things that I think make America really great. And the more I have given across the board, the more I've gotten back. I've gotten back in spades, and I know you and I have talked about that. So it's super blessed.
No, it's important, and I'll tell you the types of changes that even a small donation can make in someone's lives can change in the direction of their entire future. Yeah. Why wouldn't you want to do that if you can? And and I'm very impressed by that factor. So today, since we are with a pretty big news day, I believe the government's closed. So I have to ask you what your view of this situation with what might happen as a result of this. How long do you think it'll last? What do you think the outcome will be?
Well, it's been quite a few years since we had a shutdown, but we've had it many times before, so this isn't actually new. The playbook is kind of out there. From the political perspective, I have no comment on, what do I think is right or wrong. I'm managing money, and I want to manage through this process. The market has basically ignored this. Volatility is still very, very low. The market hasn't sold off massively. The dollar hasn't gotten crushed. Rates haven't rallied like crazy. Yeah. It's sort of playing through, I guess, kind of waiting to see where it's all going to go. That being said, the Fed cut just recently. They're probably going to cut again this year, even though I don't think they should. I think we should wait and see for more results around earnings, around inflation, et cetera. And there's a lot of unknowns that are just coming into play now from a tariff perspective and things that we haven't really seen in a while. So I think there's more time. And the economy is growing at a pretty strong pace.
Yes, it is.
Job data is getting softer. There's no question about it. There could be a couple of factors for that. So I would err to the side of patience, but they probably go again this year. Who does that help? Well, it helps adjustable rate mortgages, that's for sure, because they're adjusting off the 1 or 2 year. It helps credit card debt. It helps car loans, auto loans, and the auto industry is in a change right now as it is, and struggling, if you will. So it helps a lot of industries, and it helps a lot of people. Home building, broadly, vendor financing, all these things, I think it helps. How long this lasts, I'd be surprised if it lasts a very long time. Bottom line is the economy is growing. We didn't have the massive slowdown that we thought we might get. Mm-hmm. I think that driven by AI and by the advances, I don't think tons of people are going to get laid off and get replaced by robots. I believe robots are coming in a lot of different ways. I'm a huge fan of Optimus and Tesla and all that. But I think, like my team, we'll be able to do more with the same number of people. I'm not looking to get smaller and do more. I like to stay where I am, and maybe my world can expand. Maybe I'll see more opportunities in the bandwidth of things that we're looking to invest in that maybe I wouldn't have seen before because I'm effectively increasing my staff.
That's right.
With technology.
And the speed.
The speed is unbelievable.
Yeah, it's tremendous. Well, Sal, I just want to take a minute to say thank you. You are an absolutely tremendously good human being, a good money manager. I know that for a fact. And really, I'm glad that we're bringing back the HFA podcast with you as the first guest. So thank you.
Kind of honored to be the inaugural guest. I'm a little afraid, but low bar for everybody that comes after me.
You don't have to be afraid. So thank you.
All right, thanks.
Have a good day.
Thank you.
Take care.